Hi friends, very good evening all of you. Welcome back to Cap Classes. We have started discussing accounting standard 10 property, plant and equipment, and we have completed already two sessions. In the first session, I have given you the meaning, definitions and recognition criteria. We have solved one problem, that supermarket expansion problem. In the second session, we have discussed about the subsequent expenditure incurred on items of property, plant and equipment. In that, do you remember, we have seen two types of subsequent costs. One is day-to-day servicing cost, which is in the form of repairs and maintenance. And I told you that it should be expense to P&L. Then comes the second one, which is replacement of a major component. Replacement of a major component. Do you remember very interesting calculations we have seen, the logics we have understood, and also if the written down value of the old component which is replaced, if it is not available, how do we do fair value accounting? How do we calculate taking the cost of new component as the basis? How do we calculate all these things we have seen in session 2? Now let us go ahead one step ahead to check what is this third subsequent cost. Three. Third subsequent cost is major inspection cost. Major inspection cost of inspection you can call, or inspection cost. Now what is this major inspection cost? Think about it. You have a big factory with a huge plant, so many machines, equipments. First initial few years when you buy an asset, you can consider a computer, you can consider a motor vehicle, a car or a bike, or you can consider any equipment, any machine, like it could be air conditioner or it could be anything. During the initial days, they won't trouble you much. They work very well. But when the age of the machine is increasing, it could be, the life of the asset is 20 years. But if it is 12 years now, don't you think the kind of problems you encounter by using the machine will increase now? That is the reason normally all these big factories and industries where huge machines are installed, what they do is on regular intervals, it could be 4 years, 5 years, or it depends on the nature of the machine. What they do is they go for something called major inspection and overhaulage. They go for major inspection and overhaulage. What they do is overhaulage means, if you have, say for example, bike, all the assembling means all the components, spare parts, accessories will be assembled into a car. You disassemble it. You remove all the components into a completely knocked down condition. So if 2000 items are there which are assembled into a car, you will remove the 2000 items. You cannot even recognize that this is my asset. Then specialists, they will clean all the components with special chemicals or special acids or special lubrication oils, and then whatever the components that are completely worn, completely not useful, completely you used it to a level that it cannot function more, they will remove this kind of small parts and they'll put new things. They assemble car or the machine into a condition that it will be brand new thing. It is not brand new, but refurbished asset kind of stuff. That major inspection and overhaulage cost, whatever you incur, what is the accounting treatment of it is your part 3. Simple. Close your eyes. I'll give you one small example. I'll give you one simple thing to remember. The accounting treatment of major inspection cost is same as accounting treatment of replacement of major components. That's all. That means what is the accounting treatment of this? Simple. Cost of new component, recognize as a part of asset. Add written down value of the old component, de-recognize. Subtract. Same. So you remember this accounting treatment we have discussed in the previous session. The cost of new component is to be capitalized, add it to the value of total asset. 2. The WDV of old component which is replaced is to be de-recognized. Same. if you do not have accounting information relating to WDV of the previous component or previous inspection, you will take the new cost as the basis and you will try to reverse, work reverse to estimate what is the WDV, what is the unamortized cost. Same one problem also we have done. So same thing applies to inspection cost also. Just read this point number 1 and 2 just for revision. Read this point 1 and 2. So let us see 1 2 problems on this. Problem number 2. What happens if the cost of previous part or inspection was not identified in the transaction in which the item was acquired or constructed? Simple. Already we have done one problem also on this. Derecognition of carrying amount occurs regardless of whether the cost of the previous part or inspection was identified in the transaction in which the item was acquired or constructed. That means, Pavan sir, I do not have the data. Even then you need to do that. What is the situation? Do you remember problem number 1, what we have solved on the board? This I told you in 2 cases. Case A, when you know that it is 40,000. Case B, when you do not know that it is 40,000. Even then you need to do some accounting. 3. What will be your answer in the above question if it is not practicable for an enterprise to determine the carrying amount of the replaced part or inspection? See the answer. It may use the cost of replacement or the estimated cost of a future similar inspection as an indication of what the cost of replaced part or existing inspection component was when the item was acquired or constructed. Oh my God. Trust me, if this example is not there on the board, it will be practically impossible for a student to understand what they are saying. Pawan sir, what is the answer for question number 2 and 3? Question ICI has given you illustration, ICI has given you answer also, but the answer is also, student cannot understand. This is what you need to do. Use the present inspection, the current one, or the present component replaced and its cost as the basis to estimate the unamortized value of unamortized cost of previous component or previous inspection. That is what it is. You understand? You understand? Okay, this is subsequent expenditure. So subsequent expenditure episode is over. 4, put the heading next. Major side heading, measurement. Measurement. You remember where we started this? 1 definition, 2 recognition, 3 subsequent cost. Now 4th major subheading is measurement. So many times I told you this. What is the difference between recognition and measurement? Recognition deals with when an item is to be recorded. That means when journal entry can be passed in your books. When journal entry can be passed in your book. So recognition means when. Measurement means chalo. Recognition criteria is satisfied. Okay. Recognition criteria is satisfied. Pass the journal entry. Now the question is with what amount? Measurement deals with this journal entry is to be passed now. This journal entry at what amount this journal entry is to be passed. With what amount this journal entry is to be passed. So imagine recognize asset. Okay, recognize asset means property, plant and equipment account debit to consideration. Consideration can be cash, or consideration can be you are issuing equity shares, or consideration can be bank, etc., etc., etc. Now the question is, what is the amount here? So when can I pass this is recognition? With what amount I should pass this is measurement. You understand? You understand? So look here, measurement of PPE. So there are two points where you need to understand measurement. One is measurement at recognition. Second one is measurement after recognition. So put the heading measurement PPE hyphen measurement. PPE measurement from this to arrow marks down. Okay. So first one is at recognition. Second one is after recognition. At recognition, after recognition. At recognition, there is only one model called cost model. Only one model you have, that is called cost model. After recognition, that means, for example, on next balance sheet or reporting date, Pawan sir, I bought an asset on 1st December 2022. On 1st December 2022, with what amount you pass the journal entry is recognition date. After few months, your balance sheet will come, no? So on 31/3/2023, in that balance sheet, what will you write is measurement after recognition. For measurement after recognition, Accounting Standard 10 has given you two options. One is cost model, second one is revaluation model. Cost model, revaluation model. Two options. So this is your accounting policy. This is your accounting policy. You can choose. Pavan sir, for this particular asset, I'll go with cost model, Pavan sir. Okay. Pavan sir, for this particular asset, I'll go with revaluation model. Okay. But there are certain rules of the game. Do you remember these accounting policies are to be applied consistently? Under normal conditions, except in exceptional circumstances, you are not allowed to change accounting policies frequently. If you change accounting policy, do you remember there is some retrospective accounting involved? So practically, once you make a decision that I'll follow cost model to this particular asset, that is all till the end. You have to follow only cost model. If you say, Pavan sir, I follow revaluation model in case of this asset, till the end you need to follow revaluation model only. And another thing is, same class of assets. Say for example, you have four lands. You cannot say, Pavan sir, two lands I'll follow cost model, two lands I'll follow revaluation model. No. Lands, if you have four lands, if they are following in one class, same valuation model shall be used to measure these four lands in your balance sheet. But there can be a tricky situation where, Pavan sir, what if company has two buildings? One building is factory building, one building is corporate office building. Both of them are buildings, but are the same class of assets? Looking at the name building, you might feel they are same, but the nature the asset is put to use is different, no? Then you can have a different accounting policy. Another example is you have, say for example, under motor vehicles, you have certain lorries, trucks, and you have certain cars. Cars are used by board of directors and lorries are used to bring raw materials. Though both of them are motor vehicles, don't you think there is huge difference in the nature the asset is put to use? That means again there is a lot of subjectivity involved in picking up the accounting policy. But in the classroom, you need to understand one statement, one sentence. When you are choosing cost model or evaluation model, all the assets that fall under one class are to be revalued on or around about the same time. Like for example, 2023 March, I'm revaluing my land 1. You need to do revaluation of land 2 also around about same time. So you cannot follow different accounting policies. You cannot follow different accounting policies for same class of assets. So what is the conclusion? We are speaking about measurement. It happens at two levels: measurement on initial recognition, subsequently. Now here cost model. So Pavan sir, cost. There are certain inclusions. What is meant by cost? There are certain exclusion. So in this, in this term cost, what are included, what are excluded? This is a very big debate. Accounting standard has given crystal clear guidance so that there is no confusion. Now look here, what are the elements of cost? This is the question. What are the elements of cost? Okay, look here. Cost of an item includes A, purchase price, B, directly attributable cost, C, decommissioning liability or restoration liability. Oh my god. 1, purchase cost. 2, directly attributable cost. 3, decommissioning or restoration liability. Put a star mark on third one because you might never have seen what the hell this is in your previous studies, I'm sure. Directly attributable cost, if you apply logic and if you think, Pavan sir, I purchased land. I have paid registration stamp duty. So registration expenses are directly attributable cost. Pavan sir, I have purchased a machine. To bring the machine from my supplier location to my location, I have incurred freight. I have incurred transit insurance. I have imported the machine and I have paid customs duty. I have paid GST. I have paid purchase tax. I have paid octroi. I have incurred a lot of expenses during the transit till the asset is put to use. Pavan sir, I have paid technical, technical person is there like an architect or any engineer, mechanical engineer. For him, I have paid fee for installation costs, trial run. All these are directly attributable costs, including salaries. If the asset is constructed, you are constructing a building, you are constructing a dam. Salaries paid to those people who are actively involved in construction of dam. That is a directly attributable cost. So this is not a major issue. This is not a major issue. What is this? What is this? Simple. Sometimes what happens, imagine you have taken 1000 acres of land from AP state government for mining for 10 years. Now imagine you have to, pay upfront to acquire this right. Upfront, you need to pay, say, for example, 2,500 crores. During this 10 years, you will extract minerals out of the mine, correct? Then at the end of 10th year, what happens? The land, whatever you have taken, will become a big pit, big hole. not dwellable. You cannot do any activity on that. And literally, it is unfit for living, unfit for any agricultural activity, unfit for any industrial activity. So this 1,000 acres of land is gone because it is a hole now. It is a big hole. It is a big pit. So the lessor will write one specific clause in the contract that at the end of the contract period, when you are giving my asset back to me, it should be given in this condition. They'll put a condition that you have to fill that land with some waste or some material, so that it is not a hole, it is not a pit, and you have filled it. You can fill it with any waste. You are taking a valuable mineral out of it, and you are putting some waste and refilling it. That's fine, but don't give me whole. Give me something where you have filled it. And socially responsible companies, those companies who are more focused about the sustainability and ecosystems, environmental friendly policies they follow, they will put some degradable organic, some wastages which are not hazardous, which are not dangerous, so that again some kind of industrial or agricultural activity or human living is possible on that particular land. For this land filling, for this site restoration, you know that you have to spend 200 crores. You are taking this land in 2023. In 2033, you will incur this cost after 10 years. But you know that you have that liability, right? You know that you have that liability. Don't you think a provision is to be created? The answer is yes. So this 200 crore rupees provision is to be created. So when you create a provision, what is the journal entry? Provision account, P&L account debit to provision account. Wait, this is not, a provision which you are creating for some purpose and charging to P&L. This is, see, any provision is created for a specific purpose that I know, but this provision is attached to this particular asset, no? So accounting standard 10 says, when you estimate decommissioning liability, when you estimate that land restoration liability, capitalize the liability. Oh my God. Hold on. Pavan sir, can a provision be capitalized? The answer is yes. A provision can be capitalized. Creating a provision means you are recognizing a liability. A provision created means you are recognizing a liability. So liability means what? To liability provision account. Then what about this? Credit side is fine. Credit side is to liability account, to provision account. Debit side, normally it is P&L account debit. But in exceptional cases, a provision can be capitalized. When you are capitalizing provision, you will write asset account here, PPE account debit. Oh, that is this third component. So what are the inclusions? 1. Purchase cost. 2. Directly attributable cost. 3. Decommissioning or restoration liability. Even, I have given you this land mining 2,500 crores. Big example. Small example, I'll tell you. Small example. When you are a tenant, when you have taken a shop or when you have taken a flat from some other landlord to live or to carry on a business, you are a small businessman. You are putting one air conditioner. Air condition installation is going on. So one technician came and he is, putting a hole onto the wall. Tuck, tuck, tuck. The owner came. Owner said, hey, Pavan, what are you doing this? Sir, I am installing one machine, sir, for my business. I'm installing a small machine. Then he'll tell, no, it damages my wall. Then what happens, You have to promise him that, sir, don't worry, when I uninstall this machine, when I'm vacating the premises, I will do repairs and ensure that the wall is completely, normal. I'll put the paint also on that. And then I will go, in the name of God, please allow me to install this machine. That is what it is. If you have purchased air conditioner with 40,000, installation 2,000, and you know that after 2 years when you are vacating, you'll have to spend another 2,000 rupees for its decommissioning and land restoration or wall restoration. The cost of the air conditioner in your books is 40,000 plus installation 4,000 plus decommissioning liability 2,000. All this put together, you have to capitalize. Oh my God, that is 1, 2, 3, ladies and gentlemen. These are inclusions. Once you are thorough with inclusions, there is a lot of, text to be studied. What is purchase price? What is directly attributable cost? They have given examples and examples of, costs which should not be included. Very important. These are similar to your accounting standard 2. Even in your accounting standard 2 inventory also, these kind of things you have studied. So all these things, and then decommissioning. Then we will go to exclusions. So I hope you understand these 3 points. Now you need to read theory, and then I'll give you some examples and we'll solve some problems, and then we'll go to exclusions also. Clear so far? Any doubts till this?